Platinum has a habit in the winter that most people sleep on. Over the last 25 years, platinum has averaged a 7.8% increase from December 6th through February 20th, with an 84% win rate. That's an annualized return of north of 40% during that time period. In plain English, most years this thing tends to pop into February. Now lay in the seasonality on top of what's happening right now. According to the World Platinum Investment Council, 2025 is expected to see 602,000 ounce deficit, roughly 9% of the annual demand in the and it's the third year in a row that the market is in the red. Above ground stocks have been eaten away by years of shortfalls. Lease rates are above 15%, which is what you see when you want to get physical metal. It's genuinely tight. At the same time, CME warehouse stocks have jumped, which looks more defensive positioning than a tighter market and weakness. ETFs have seen outflows, but mainly profit taking from a surging market, not from fear. Platinum is up 16% during the third quarter and a little bit over 70% year to date as of November 1. Even after that, it's still about $800 an ounce below its inflation-adjusted all-time high. On the macro side, platinum is getting the same tailwinds as gold and silver. Falling rates, a softer dollar, slow rotation back into hard assets. Add to that the critical mineral story. Platinum in auto catalysts, hydrogen, fuel cells, tighter emission standards, and more players are saying, forget about leasing, I actually want to own it. Technically, the chart backs this up as well. Platinum is in a clear uptrend, trading above its 50, 100, and 200-day EMAs, making higher highs and higher lows. On the bigger picture, there's major support around 1,500 and again near 1,300. These zones are where dip buyers have every reason to show up if we do get a pullback. Seasonally, the December-February window has been one of the strongest in the entire commodity complex, and some past years don't just grind higher, they actually ripped with a single season move of over 40%. What are the risks? The risks are more profit taking to the ETFs, a sharp drop in lease rates, which would signal a less urgency for physical metal, and a strong dollar bounce around the Fed's December meeting, which could hit all metals, not just platinum. But the bigger picture is like this. You've got tight physical supply, a statistically strong seasonal window, a bullish macro background, and price in a confirmed uptrend. So if you watch metals, this December is not a bad time to keep some platinum on your screen and treat any real dip as something to think about and not something to ignore.